is Business Weekend with Ross Greenwood.
Hi there and welcome to Business Weekend. I'm Ross Greenwood. It's great to have your company today. Coming up on the program, Donald Trump has swept back to power like a tornado, hitting rival countries with tariffs, closing government departments, banning trans people from playing sport and declaring that America could own and redevelop the Gaza Strip. We followed the implications of this, starting with the trade war with China.
Beijing wants to talk, wants to negotiate to head off even greater tariff hikes and export controls from the Trump administration.
And this week, many of America's biggest companies dumped their diversity and equity programs that force them to have quotas and to track the number of women and people of different racial groups that they hire. So what about here in Australia?
Our primary goal is to look after our shareholders.
Yeah.
What a novel concept. And we can't look after every single other social issue in Australia.
And two chief executives of our biggest oil and gas companies this week said it's too late for Victoria to overcome acute energy shortages because the state will have a lack of gas. We speak with one of those, Meg O'Neill, the boss of Australia's biggest energy producer, Woodside, who says it's simply too expensive to ship gas from WA to Victoria.
You almost need to start with getting the policy settings right, doing things like getting rid of the moratorium, and making sure that the government is voicing support for continued gas investment.
But look, let's start with Donald Trump. Where else can we start? It's almost hard to believe it's only been back in its Oval Office for a little over 2 weeks. So quick has the pace of change been. What's clear is this presidency will continue on at this breakneck speed. The tariffs war with China, suspended tariffs with Mexico and Canada, and threatened action against the European Union show Trump will seek to drive more manufacturing back onto US soil. One small illustration this week was the US Postal Service. It banned all goods from China and Hong Kong with the view that all these items, billions of them every year, would be subject to customs searches, then tariffs. Previously, anything worth less than $800 could enter the US free of any charges. Well, that was overturned following concerns it would simply swamp the US customs officials, and instead a blanket tariff of 30% was put on every small item that's posted from Hong Kong or China. In retaliation, of course, China's imposed tariffs on US coal, oil and gas and restricted the sale of critical minerals such as molybdenum and tungsten, which are essential in aerospace, defence and computing. And never forget that Australia has a chance to get caught up in all this. Donald Trump might well insist that we take sides in the trade war or risk sanctions on our own key goods, including and most likely beef. And woe betide Australia if it's discovered that Australia is being used by Chinese companies to gain free trade access to America. Well, Lingling Wei is the chief China correspondent for the Wall Street Journal and the co-author of the recent book, Superpower Showdown, How the Battle Between Trump and Xi Threatens a New Cold War. In 2020, she was one of 3 Wall Street Journal reporters expelled from Beijing. I spoke with Lingling from New York a little earlier and asked her about the escalation in the trade war and what she imagines it'll look like in 6 months' time.
Thank you, Ross. It's great to be here. What we're seeing right now is only the beginning of a fresh trade war. As you pointed out, Trump administration slapped additional 10% tariffs on everything China sold to the United States, which covers more than $400 billion of goods. At the same time, China has retaliated. I think what's notable is that China's retaliation so far has been rather measured. That shows 2 things. Number one, President Xi Jinping wants to project strength, wants to show to Trump that China has the ability to inflict pain on U.S. economy. On the other hand, the very fact that the Chinese retaliatory tariffs have been targeted shows that Xi Jinping wants to leave room open for negotiations. I suspect that very soon the two sides will start negotiating. As we reported earlier this week, China has already prepared an opening bid for negotiations that involves reinstating the so-called Phase 1 trade agreement China signed with the first Trump administration in early 2020. That Phase 1 agreement, as we know, China really didn't enforce it. So their opening bid mostly involves restoring that agreement, centered on more purchases of American products by China, and also, China as another part of this opening bid from China is a renewed pledge not to devalue the yuan, the Chinese currency, to help Chinese exporters, and also an offer to the United States that China is willing to make more investments in the U.S. So, we're seeing measured response, measured retaliation effort from China, and, that shows to us Beijing wants to talk, wants to negotiate to head off even greater tariff hikes and export controls from the Trump administration.
Okay, so for both sides, it's pretty important because many American manufacturers have gone to the United States, Apple being one of the most famous, but Tesla as well manufactures in China. Now, Donald Trump's tariff plan is to try and bring manufacturers back to America. The question is whether that is counterproductive to both sides, because, of course, if you suddenly drive up the price of goods, then American inflation takes off and potentially interest rates don't come down so quickly. So it has broader economic impacts because of the proliferation of manufacturers that have previously gone to China.
President Trump has called himself the tariff man, so he sees tariffs as the solution to everything. So it's, to be expected that he will continue to use tariffs as a way to, accomplish whatever goals he has in mind. What is not very clear right now is what is it that he wants from China. During the first U.S.-China trade war under the first Trump administration, he had a pretty clear goal in mind, which was to basically reduce the China's trade surplus with the United States. So that led to this Phase 1 agreement requiring China to buy more. This time around, does he have the same target in mind, or the target this time around is much broader? I think it's very interesting point. I think it's very interesting fact for us to consider, being that as soon as Trump took office, he delegated his federal agencies to do multiple trade reviews of the U.S. relationship with China. So those reviews will be due in early April and could potentially lead to a bunch of policy recommendations that would involve, both heightened tariffs on not just Chinese products, but on, third countries that Chinese companies have used to sell to the United States, and also could potentially lead to even expanded export controls targeting China. So, we're basically seeing, Trump sending out very strong signal about his willingness to assert dominance, over this relationship. At the same time, his team also is preparing a wide-ranging policy tools that could be potentially used to pressure China. So, we will see how really, it will end up, in a few months' time, and we will see whether or not both sides will really get down to business and start talking about what specific targets, what specific objectives they hope to achieve through negotiations.
And so countries such as Australia are in an unusual position. We have a free trade agreement and very strong military ties with the United States. At the same time, our major trade partner, and with whom we have a free trade agreement, is China. And so it is one of these issues where third-party countries, as you mentioned, have got to be very careful about their own politics and the way in which they trade, not to incur the wrath of China on one hand or the wrath of Donald Trump on the other.
Right. So a lot of countries may find them in, between a hard and rock place, because unlike the first trade war, it was very clear. It was a trade war between the U.S. and China. And this time around, the trade war potentially covers way more countries, and many countries may find themselves having to choose sides. For example, this, potential move intended to prevent China from using certain countries to export to the United States would potentially lead countries like, Vietnam or Mexico deciding which side to take, whether or not they would, continue to let Chinese products use their countries to export to the U.S. That would lead to maybe higher U.S. tariffs on those countries, or they would side with the United States and potentially losing investments from China. That's definitely quite a geopolitical question and involves a lot of cost and benefit analysis by all those individual countries.
It's going to be fascinating to see what takes place, because obviously this has broad ramifications. But there's one issue, and that is that Donald Trump is only in power for 4 years. So would it be Chinese policy simply to ride out Donald Trump's administration and then to seek the deal with the next president of the United States?
That's a great question. I do think because China's economic situation right now, which is quite weak, the Chinese leadership does have a strong intention to cut a deal with the Trump administration to head off, greater attacks from the administration. At the same time, whenever you talk to Chinese officials, they would often tell you they're not in a rush to cut a deal. They can handle the additional 10% tariff even higher. So, definitely China has an interest in negotiation and has an interest in cutting a deal. But, they're also not in a hurry. Maybe it's even in their interest to drag things out, to just buy time so that they can focus more on get their own economic house in order.
Lingling Wei, it is fantastic to talk to you today, the chief China correspondent for the Wall Street Journal. Many thanks for your time.
Thank you.
So let's go to another dramatic shift since Donald Trump was sworn in just a little over 2 weeks ago. Diversity and equity inclusion. The PC policy of putting targets on the diversity of gender and race in the workforce seems to have done an immediate U-turn in America since Trump became president. Trump ordered all federal DEI workers to be placed on paid leave and closed down their departments inside government. Google this week scrapped its diversity hiring targets. The retailer Target, the FBI, Amazon, Meta as well, McDonald's, Walmart, they did the same thing. But Australian companies haven't been so quick to act, maybe because of our laws, including the Sex Discrimination Act and also mandatory reporting laws through the Workplace Gender Equality Agency. So let's bring in here the former president of the Business Council of Australia. He's hired a few people in his time, Tony Shepherd. Tony, many thanks for your time.
Ross, it's a pleasure to be with you again.
All right, so you could argue this is two old dinosaurs, two old white blokes talking about diversity and gender equity. This might not be the right place.
Well, the ageism is growing, no?
Well, that's right. That is true. That's a good point. So I just want to go here. Is this simply, in your opinion, gone too far? Or is Donald Trump onto something here, to your sense?
I think Donald is onto something here. We're similar countries, as you know, the United States and Australia, but we're quite different in many respects. So they invented all of that wokeism stuff,
Yeah.
And now he's stepping back from it, and it's proving extremely popular in the US, and that's one of the reasons he was elected. He got 58% of the vote, which in the US is high. And that is starting to resonate in Australia, and Australian business is starting to say, well, look, our primary goal is to look after our shareholders.
Yeah.
What a novel concept. And we can't look after every single other social issue in Australia. Now, we pride ourselves on our diversity and opportunity. This is the country that's taken hundreds of thousands of refugees from war-torn countries, offered them a new life, offered them a future in a safe environment and what have you.
In fact, you could argue in Australia here, a land of great migration, that many of our wealthiest people, many of our biggest businesses have been created by migrants. So Australia has been inclusive when it comes to migration. 5 million people have come in over the past 3 years, for example.
Look, I'm a child of the Second World War. This country grew because of immigration. We would be nothing, we'd still be a rural economy if it were not for immigration. It has been a phenomenal contribution to our social and economic life. And certainly our food's improved dramatically as well.
Well, that's right. So, OK, but there's another aspect of this when we talk about diversity and equity inclusion. That is about females in the workplace.
Yes.
Now, the one thing I would say is noting that there is more than 50% of graduates from our universities right now are females.
Yes.
You don't want to waste those brains. No. You want to use every one of those brains as best as you can.
Yeah, you do. We're short of people. I think what business is swinging away for is this firm quotas.
Right. Okay.
Because
so
what happens with a quota is it's demeaning to the women. And I've appointed and worked with numerous outstanding business and public servant women who I would promote and reward without even thinking about, and I have done that in many cases. But if you start putting them into that role because you have to get your numbers, that's insulting to women. They can, in modern Australia, in modern companies and in the public service, they'll get the jobs that they deserve, and that's better for them and better for society. And I think there is a swing back to that in Australia now.
All right, so do you get a sense ever, in your experience, that there has ever been any tokenism in boardrooms or in public service?
I think it happens on boards and it happens in companies and it happens in public sector at times. I think there has been some tokenism.
So does that mean that there is discrimination against men in the workplace?
Well, there would be. It's discrimination against men, for sure. But it is actually demeaning, in my view, to the women whom we're producing are outstanding, And I look at my own daughters and my great-granddaughters, and they are outstanding. I mean, they're hard-working, highly intelligent, by the way, quite tough at times, but they get the job done, and they have all been promoted in reward for their ability and their contribution to the outfits they work for.
So there's one aspect I want to also raise with you, and that is when it comes to women in the workforce. The participation rate of women in our Australian workforce is right now at the highest it's ever been. Now, that's through necessity of families needing to actually pay very expensive mortgages in capital cities. But it comes back to the skills that women have developed and been encouraged to develop by employers, again, to keep their brains and skills in businesses, even when they've had kids.
Well, look, it's certainly the economic pressure that keeps them working, and that's the same in the United States particularly. But it's also because the opportunities are now there and they're good at their job, and childcare helps them a lot, and they can do that. They can do the two, but they're hardworking. See, and the average Australian family now, and that the middle group, which actually is the ones that are the majority group in Australia, unlike America, where the elites and you've got the very poor and not too many in the middle. But the average Australian is hardworking, mum and dad, 2 kids, both the mum and dad are working, In some cases, mum's making a lot more money than dad.
Yeah.
And that's great, and that's a reward for their excellence. But but they're still very strong families with a strong focus on their children and their health, welfare and education.
Okay, so let's say, for example, we have got the Sex Discrimination Act. You've got, quite clearly, you've got laws in this country that prevent discrimination in the workplace.
And I think that is fantastic, and that's true to our values.
So we don't So we don't need to unwind those laws.
No, we just need how we implement them without being silly, and give. Just go back to the Australian basic philosophy, which probably comes from our Christianity background. Give everybody a fair go. A fair go is the Australian call sign, and that is a fair go for everybody.
All right, so
male, female, immigrant, not whatever, their diversity, what have you. The only discrimination I'm getting at the moment is ageism.
Ageism, all right. It's okay, right. We all get that a bit. Anyway, so the one thing I would say is that given that Donald Trump is there and has unwound clearly what many seem to be excesses in that US system, do you sense that even here in the boardroom there may be a similar change in mood?
I think I can sense a movement already.
Right.
I can sense.
And is that about the reporting of it, or is it about the implementation?
But it's everything. It's reporting and implementation. You know, because you can be spending so much time on that and putting in people that aren't really qualified for the job out of that passion for diversification, but that may be to the disadvantage of the company in terms of its productivity and output. But in terms of women, as I've said, and I can quote some of them now, but they're just outstanding, and they've got there as CEOs or chairs or what have you through their excellence.
Yeah.
And they're doing a fabulous job.
All right, then they used to talk about the Old Boys Network, right? The Old Boys Network used to be the group of directors that be on 6, 7, 8 boards or whatever it might be. Yeah. But there's another aspect of this, it seems, is in this day and age when computer hacking is massive, when artificial intelligence is massive, it seems to me that if there's a need for some sort of diversity on boards, it's to get away from the old idea that your board is going to be chock-a-block full of accountants and lawyers.
Yeah, and yes, I agree. And one of the things that worries me about our boards is the lack of experience in engineering, science, and in things like construction and development. With this total focus on law and accounting. And I think we need diversity in that area too, in terms of the skills of boards. How often do you look at some of those public company boards and you say, how many on that board actually understands the business that they're now a director of?
Pretty often, I'd say, Tony.
Yeah.
I think that's pretty true, isn't it?
It is.
You've been on a few boards, haven't you?
I have been on a lot. But I always try and look, I'm no genius, so I always surround myself with outstanding people who know more than me.
And maybe that is the bottom line. Tony Shepherd, it is always lovely to chat to you, and many thanks for your time today.
My pleasure.
There you go, Tony Shepherd there. Well, coming up after the break, the energy crisis on the east coast of Australia will only get worse, and the state that's likely to be affected most is Victoria. When we come back, I speak with the Chief Executive of Woodside, Meg O'Neill. Being with us here on Business Weekend. Well, Australian and American stock markets right now are trading close to all-time record highs, lifted by optimism about Donald Trump's pro-business agenda and even the delaying of tariffs on Canada and Mexico. There's also an increasing chance of interest rate cuts by our own Reserve Bank. The big question, as Edward Boyd seeks to discover, is whether company profits can keep up with their share prices.
In this reporting season, which has just got underway, one thing is true. Any company that misses its targets or disappoints investors will be instantly hammered by the markets.
Yeah, look, it always tends to be the way with the reporting season. Miss and you get punished, but I think now even more so. Valuations are stretched. I was looking at the ASX 200, something like 40 to 50 stocks have performed above 50% for the past 12 months. And when you're getting that sort of performance, you need to deliver. So, we need to see some really good results, and probably more so commentary as to the outlook. So I think if you look at the Aussie economy, it's definitely turned the corner. It's not necessarily in real positive territory, but it's looking better. And as a result, we want to see companies talk about better outlooks into the second half in order to maintain these sorts of share price performances.
President Trump's tariffs and China's retaliation have been major talking points this week. The dual-listed Fisher & Paykel Healthcare has already flagged rising costs in the next financial year due to Trump's tariffs. And experts believe more companies will need to provide tariff costings over the next few weeks.
You'll probably find a lot of companies are voluntarily giving details of their supply chains at the upcoming results. A lot of questions will come up about supply chains and exposures to certain jurisdictions. So I think that's going to be a real key focus. And then more holistically, I think looking at first order and second order effects of these of any changes that might come in. Because obviously, if you get tariffs placed on a country, it does alter trade flows. It alters behaviours from companies, which can be both a positive and a negative.
US earnings season is already underway, and last month, the Chinese artificial intelligence-powered chatbot DeepSeek delivered a curveball to the US tech sector, claiming it was operating on a fraction of the cost of its peers like OpenAI's ChatGPT. This caused Nvidia to lose about $600 billion in value in a single trading session, the biggest wipeout in American corporate history. The remaining Magnificent Seven tech stocks were hit too.
Those companies in that part of the market has become quite highly valued, and anytime something that's really highly valued is open to a shock, that just amplifies the sell-off that you saw. What was notable about that, there was that initial challenge, not necessarily around the US dominance, but more around, do those real estate companies really justify the spending and capex investment they're doing? Can they translate that into sales? And what DeepSeek did was saying, well, we can produce this stuff at a lot lower cost, really challenging that idea on that capex spend and therefore the sales that may come through on the back of that.
Closer to home, the consumer sector seems to be faring better thanks to the improved interest rate outlook. RBC Capital Markets are expecting mid-cap stocks like Breville, Flight Centre and Temple & Webster to perform well.
Yeah, so we really like Temple & Webster. They're one of our top picks in our coverage universe. As you said, online's doing very well. We see them continuing to take share in the furniture space, taking share from incumbent bricks and mortar retailers, but also there is a structural tailwind towards online penetration in furniture sales. So they've got a target of getting to $1 billion in sales. And then and potentially looking at going offshore with an acquisition or something similar.
Within the consumer category, there are still winners and losers. Travel stocks and home-focused retailers like Bunnings and Harvey Norman are expected to have a good year, while the consumer staples sector could struggle.
Yeah, look, consumer is really mixed. I mean, there are certain segments of the market that are doing very well. If you look at the discretionary spending, so the big ticket stuff and furniture, etc., so the JB Hi-Fis, the Temple & Websters, Nick Scali's, etc., they're doing really well because people seem to be more confident in terms of the outlook. I think it's because they're not expecting rate increases. They've had some tax cuts. They're feeling a little bit more confident in that regard. Other segments within the category are much more complex. I think the supermarkets, for example, they're not really seeing that strength come through. People are being more cautious as to their spending in that regard. And I think when you look at certain channels, some of the global retailers, again, lots of things to factor in. One that we continue to like is Lovisa, but that's more of a store rollout strategy as well as a high quality sort of vertically integrated model.
The family monitoring app Life360 is expected to perform well too. The tech stock has more than 80 million subscribers, but only 2.2 million are paying users. Its share price has jumped about 200% over the past 12 months.
So a lot of people don't know about these guys. They have just under 80 million active users daily. In terms of daily active users in the US and app downloads, they're just below Amazon and 5 places above Netflix. So that's pretty impressive.
And despite the recent tech sell-offs, global asset managers are still bullish on the companies that contribute to artificial intelligence and technology.
For us, the thesis around AI hasn't really changed. It's very much one of a secular theme we think is going to play out over many years. And in the near term, these companies are still sitting on good cash flows. They still have good earnings, and so therefore would make a good investment. However, over time, if you do get those cheaper cost alternatives coming through, that should boost productivity in economies as companies can take advantage of that, and you see that technology broaden out and lift margins in the rest of the market, allowing the equity market to continue to roll through.
Now, this week, two chief executives of major oil and gas companies called out the Victorian government in particular for gas shortages, which they say will cause problems for at least a decade. The Victorian government in future will rely on gas being piped from Queensland, despite the fact there are significant unexplored gas provinces in the Gippsland Basin in Victoria. Exacerbating the issue, the amount of gas flowing from the Bass Strait fields is expected to halve over the next 3 years. Well, this week, after she made that big call, I caught up with Woodside Chief Executive Meg O'Neill on the sidelines of an event at the Melbourne Mining Club.
The main point I was trying to communicate is the importance of affordable energy to economic prosperity and the role of gas in providing that affordable energy to customers here in Australia.
OK, so bottom line of that then, you have a lot of gas on the Northwest Shelf. You've got a new project, Scarborough, coming on. You've got, liquefied plants with Pluto 2 coming on board. What stops you from sending gas from the west coast of Australia to the east coast?
Look, it's probably worth starting with our investments here in the east coast. We're a partner with ExxonMobil in the Bass Strait joint venture, and all of the gas that comes onto shore from those fields is provided to local businesses, power generators, and households. So we already are a player here in the East Coast gas market. But the concern we have is those offshore fields are now in decline. It's a finite resource, and as the resource starts to decline, we're already seeing the signs in Victoria of energy shortfalls. So there was a point in time a couple of years back where gas was in high demand. There were outages in other systems. There wasn't a lot of sun, and gas came to the rescue. The worry that I have is that with the decline in the natural fields, if we don't get something else to the market, there'll be some real challenges here in Victoria.
OK, so there'll be challenges in Victoria, potentially up the east coast as well. Isn't one of the answers to go to one of the world's greatest gas resources in Western Australia and to ship that gas to the east coast? Is that not one of the answers?
That is absolutely feasible. It's something that we've been looking at. It's something we've been working with a couple of companies here on the east coast to see, is it going to be feasible to bring LNG from the west over here to the east coast market? Because the market's going to need the gas. I think that's very clear. It has been challenging to get approvals for developments here. And, it's fascinating. The big gas sink is in Victoria, but getting permits even for floating regas facilities, which is a fancy name for a boat that's tied up at a quay to offload gas and then warm it up and put it into the grid. It's been very difficult to get those approvals. So that's something that we're keen to continue to work with other industry players and the government to get approval for.
OK, so
the bigger opportunity, Ross, is to figure out how do we unlock investments in the gas potential that is here in Victoria. And you almost need to start with getting the policy settings right, doing things like getting rid of the moratorium, and making sure that the government is voicing support for continued gas investment.
OK, so then let's go back. Yes, you're right about gas beneath your feet. That is quite clearly the cheapest source of gas, close to the pipelines, get it into the grid. But if it has to be that the gas has to come from the west coast to the east coast, what happens in regards to the pricing? Because a lot of gas is priced at international parity prices, which is higher than the domestic gas prices, which quite clearly means that industry would not buy that gas simply because it's too expensive.
I might frame it a little bit differently, Ross. So think about the complex reality of bringing gas from the west of Australia to the east coast. You have to produce it from the fields, and there are offshore fields. You have to bring the gas onshore, process it through very expensive infrastructure. And to give you a bit of calibration, the new LNG facility we're building at Pluto costs plus or minus $6 billion US. So that's not cheap. And then you have to put it on a ship and move it around. So of course it's more expensive than the gas you're standing on. There's so much investment required to be able to take the gas that comes from WA, process it, and get it here. Of course it's more expensive.
I get
now, is
that.
it linked to international prices or not? That'll be a commercial matter for the parties involved to discuss.
Okay, so then you get to the other point, though, is that if the gas becomes more expensive because either it's not being drilled or indeed it's more expensive to bring from the west coast to the east coast, isn't that counterproductive to Australia's competitiveness when you've got a president in the United States right now who's got a policy of drill, baby, drill and wants more projects and cheaper energy in America as compared with what it would be here in Australia?
Yeah, and Ross, that's the thesis of my speech, which is energy is essential to economic prosperity. And in a country like Australia, similar to the US, you're going to need a wide range of energy sources to meet the needs of consumers, households, and businesses that want to grow. The US is a great example of an economy that is developing all sources of energy. It's got oil, it's got natural gas, it's got solar, it's got wind, it's got nuclear. Everything is in the mix. And Drill Baby Drill does two things. One, it's very clear support for oil and gas. But two, it's also a message saying that energy, more energy in the market keeps prices down, which enables other economic growth. And that, I think, is the most important message that we can all take away from the Drill Baby Drill headline.
Okay, so then you've got a federal government that has just shelved, the Prime Minister has shelved the nature positive legislation, which would have added potentially another layer of bureaucracy. Even though the Environment Minister, Tanya Plibersek, says it would reduce bureaucracy, the reality is it would be another agency to have to deal with to be able to get gas projects up and operational. So, for example, your North West Shelf extension project has taken 6 years to get approvals. But the problem is we don't have 6 years to wait before these gas shortfalls, especially on the east coast of Australia, before they occur.
No, we don't, and it really does make the head spin. So North West Shelf is a facility that's been producing domestic gas since 1984, producing LNG since 1989. The existing environmental approval is till 2030, and we went to the government and said, look, we just want to increase it to 2070. We're not changing anything in our footprint. We're staying in the same fence line. It's the same equipment that we've been using for decades. It's taken 6 years for the state government to give us approval. And now we also have to get Commonwealth government approval. So it just makes your head spin that you've got two independent regulatory agencies making a decision on the same question, which is just extending the life of something that's already been running for 30 years. It's crazy.
So you, of course, have choices to where you invest capital. You and I have talked about this a lot. You have now operations in Africa. You have operations, obviously, in Western Australia. You've got it in the Gulf of Mexico. You've got it in the United States. You go where you get best bang for your shareholders' dollar and where the resource sits. That's a big thing for Australian shareholders, but even for the Australian government to try and get its head around, surely.
When we're thinking about where to make our next investment, we look at a number of factors. First and foremost, we look at, is the resource there? We don't have the luxury of building wherever we want. We have to go find the oil and gas fields and those opportunities. Second thing we look for is, what's the investment climate? And that goes to, does the country really want our investment, want us investing in these commodities? What's the tax structure? What's the wage structure? What's the supply chain cost? What's the energy cost? So those are all factors that we look at. Look, we're comfortable and, we're a proud Australian company. We've made a decision to invest in developing the Scarborough field. We would love to be able to invest and develop the Browse fields, again, and continue to supply gas to our customers here, particularly in Western Australia, and then also our LNG customers. And you look at the U.S. and you'd say, well, actually the U.S. is probably ahead on a number of those metrics. Tax rates lower, employment model is a bit more affordable, supply chain is cheaper, you've got a big contractor community, so the U.S. is very competitive. And again, it was another point in the speech I made, is that we're in a globally competitive world. Australia has been very successful in the past, but we need to always be upping our game and improving our performance to make sure we stay competitive.
Meg O'Neill, it's always great to chat to you, and many thanks for your time today.
Thank you, Ross.
Coming up, Treasurer Jim Chalmers this week considered the government needs to work out a way to charge electric vehicle owners for using our roads. The man who's pointed out the free ride that EV owners get for more than a decade, Infrastructure Partnerships Chief Executive Adrian Dwyer, is with us after the break. Great to have your company here on Business Weekend. Well, this year the government will raise about $16.5 billion from fuel excise. That's from the 50.6 cents a litre tax you pay on fuel, every litre of fuel sold in this country. And though the sales of electric vehicles have fallen sharply in the past year, the reality is that more EVs will be sold in the future as more models become available and as improved battery technology extends their range. Now, what's been missing for years is a way for electric vehicle owners to contribute to the building and maintenance of our roads. Well, that's something Adrian Dwyer from Infrastructure Partnerships Australia has been banging on about for more than 8 years now. And this week, for the very first time, Treasurer Jim Chalmers acknowledged something has to be done. I spoke with Adrian Dwyer a little earlier.
Well, I was thinking earlier, Ross, that you and I have been talking about this for nearly a decade. So it's good that we're now getting a bit of traction on it at the federal level. There was, of course, a road user charge applied to electric vehicles in Victoria a few years ago. Unfortunately, the High Court found that was an excise and therefore can only be collected by the Commonwealth Government. That squarely puts the ball in Jim Chalmers' court. And the thing I've been really pleased by today is not only has Jim Chalmers said that this is an area he's keen to look at, but so has the opposition. That means we've got everybody on the same page. This shouldn't be a politically charged issue. It should just be a sensible reform that we get done.
OK, because the reality is that somebody has to pay. And what happens is that money from the fuel excise simply goes into the bucket and then a separate bucket is created to pay for the road. So nobody actually ever correlates, what's coming from fuel excise to what's being spent on the roads, do they?
That's right, but I think more importantly at the individual driver's level, if you're filling up a Toyota Corolla, a 50-litre tank, that just over 50 cents a litre on fuel excise, that's $25 a tank that's going to the federal government as tax that's notionally spent on roads and other government services. As that money declines, it means there's less money to spend on roads or the money has to come from somewhere else. It will decline because cars are getting more fuel efficient, but as electric vehicles pick up and they have a greater part of the fleet, there's going to be less and less money to spend. We know if we've got less money to spend on our assets, they deteriorate faster and we don't build the assets we need for growth. So this is a problem that absolutely needs to be fixed. And the best way to do it is to have a direct connection between what we pay and what we get.
OK, so then the real issue here is how do you actually charge users in the future? Is it a levy annually? Is it a per kilometre charge? Does it mean that we end up with more toll roads? What's the most efficient way, do you think, to actually charge for these roads and especially these electric vehicle users?
Yeah, so the approach that has been developed over 20 years of debate and discussion about this is that a distance-based charge on electric vehicles is the best place to start. As fuel excise goes down, as more vehicles become electric, that would be replaced with the distance-based charge on electric vehicles. That's a direct link between what you use and what you pay. That's the sensible and fairest way to go about this. I think the challenge is, how does the federal government do that? The ball is in the federal government's court in terms of their right to raise this tax or this user charge, but they don't register any vehicles, they don't licence any drivers, so they need the states on board as well. That's why we think it's really important that the federal government and the states, after the election, get together and come up with a plan where they can all work together to make this happen.
OK, so I'm trying to think about that in my head. I agree with you that you should pay on a per kilometre basis, but what is that? Does that look like a logbook? Does that look like a manual entry when I put my tax form in? Does that look like the government is actually monitoring my odometer in the car? What is it?
Yeah, so there's a few systems around the world actually in operation, and we had one operating in Victoria for over a year. So we've got a kind of proof of concept on this. New Zealand has a road user charge on electric vehicles. Now, the New Zealand model, you buy when you register your vehicle, you buy a certain number of kilometres and then that's audited against your travel over time. The Victorian model had odometer readings. Initially, that was going to be a manual, effectively a photograph of your odometer, but over time would move to a more electronic system. But there's no privacy concerns here. There's no more information required than someone could get by looking over your shoulder and seeing how many kilometres you've travelled. I think that's really important. What we don't want is a situation where this becomes a debate about privacy, about knowledge, about where you've been and how fast you're going. That's not what this is about. It's simply enough information to determine how many kilometres you've travelled in a month or a quarter or a year, and then alongside your rego renewal, you pay for that additional road user charge. And we're not talking about huge sums of money here. The Victorian model that was in place was 2.5 cents a kilometre. So for the average user, that was about $300 a year. Everybody else is paying that much more than that in fuel excise. It's only fair that the driver of an electric vehicle that doesn't pay fuel excise does contribute to the upkeep of roads.
I'm sitting here listening to you telling me that, Adrian. It comes to me that the current excise on petrol is an incredibly efficient tax. There's no readings, there's no odometers, there's nobody having to check anything. It's simply a straight out tax on sales. But you can't kind of do that for electric vehicles, can you?
Yeah, well, it is a great tax from a Treasury's perspective, which is why it's persisted for well more than 50 years. It's a relatively simple tax to collect. It's very hard to avoid. It's collected at the wholesaler level, so it's levied on a very small number of taxpayers from a collection perspective. The problem with it is in terminal decline, partly because cars are getting more fuel efficient, but more particularly into the future because cars are becoming electric and therefore don't pay for it. The other problem with fuel excise is that you're able to avoid it by buying more modern technology, despite the fact that you still use the roads that it notionally pays for. So it's a regressive tax. That means that those that can least afford pay the most. Those travelling longer distance in the bush pay the most. Those travelling on worse roads pay the most. So we've got to move to a new system eventually anyway, but electric vehicles are actually the opportunity here. They're not the villain, they're the opportunity, they're the solution. They're actually the hero of this story. They can be used to get this in at the early stage of uptake, the thin end of the wedge, and then as fuel excised vehicles, so petrol or diesel vehicles, become less common, we've already made the change so everybody's making their fair share to the roads that we drive on. And it's worth remembering, electric vehicles don't levitate. They use the roads the same as anybody else. Roads need to be provided for electric vehicles, and they use electric vehicles and consume them, so they should make a fair contribution the same as other drivers.
Adrian Dwyer from Infrastructure Partnerships Australia. Always good to chat to you. As I say, we've been doing it for a decade, and many thanks for your time today.
Thanks, Ross.
And that's it for the program this Sunday. Thanks for your company. Up next, all the latest news right here on Sky News. Business Weekend returns next Sunday, but of course you can keep up to date with all the latest business news with our daily program, Business Now, 4:30 p.m. Eastern Time, and via our website, skynews.com.au. Thanks for your company today. I'm Ross Greenwood. We'll see you next week.